Are you planning on selling put options for weekly or monthly income? If so, this is the only video that you're going to need to know on how to generate income with the wheel strategy by selling put options safely for consistent weekly and monthly income, as well as covered calls and effectively running the wheel strategy. I'll be covering the specifics of how to pick a strike price, expiration, delta, technical analysis, and all the steps that I use to sell puts to grow my personal portfolio. I've been trading for about 10 years now, and I have combined my experience with the teachings from Goldman Sachs, some of my experience at Wharton, Drexel University, my economics and finance degree, and everything that I know into this video because I want to show you how to generate consistent weekly income with my favorite strategy. I'm also going to cover what you must avoid when running the wheel strategy and what other channels do not talk about because they don't have a degree in risk management and experience like I do. So too many investors really get into trouble with risk management and they completely ignore it. Of course, I'm not a financial advisor or anything, but in my opinion, I am wealthier than 99.9% of even investors, and I have more experience. So I want to give you my teachings, and I'm very excited today to show you how I've been making money every single month. I promise, if you want to maximize not just your returns, but also take the least amount of risk, I'm all about safe passive income. You're going to want to watch this video until the end. I'll be giving you a bonus to increase your return to risk ratio so you make even more money. So if you appreciate this, hit the smash button or like button, whatever, and let's jump into it. Let's not waste any more time. When it comes to the wheel strategy, picking the right stock for selling put options is absolutely crucial because if you pick the wrong stock, you're not actually going to make money. If you pick the right stock, you can get a lot of the other things I'm going to cover in this video wrong and you're still going to make money. So let me explain to you why this matters. A put option is essentially a contract between two parties. As you can see, I have numerous put option positions in my portfolio open right now, and many are actually expiring this week, the following week, and in a month. Having sold put options for nearly a decade, I can tell you that this is a straightforward agreement. The buyer of the put option anticipates the stock price will fall, and they're paying for the right to sell you the stock at a specific price. On the other hand, as a seller, you're betting that the stock will stay above the strike price. With the wheel strategy, you need to be prepared for the possibility of owning the stock if the option is exercised. That means you should select a high quality stock that you would be comfortable owning. In fact, you should be happy owning. If the stock does fall and you end up having to buy 100 shares, you want to make sure it's a stock that you absolutely believe in and would be happy to hold anyways. This way, the wheel strategy is actually helping you buy stocks for a cheaper price than they're trading at the market right now. It's actually a crazy strategy. For this reason, I always recommend selling puts on stocks that you consider valuable and worth adding to your portfolio. To use the wheel strategy effectively, start by choosing a stock that you like, then decide on the appropriate strike price, which I'm going to go over in just a moment, expiration date, and delta for your put option. This approach ensures that you're not just building a solid portfolio, but you have a solid foundation for the wheel strategy itself. Now, let's delve into why these elements are so important. When selecting your strike price, think about where you're comfortable buying the stock. If you're eyeing a $100 stock, you might want to sell a put option at 95 or 90 strike price. This way, you're setting a level where you feel confident buying the stock if necessary. And the expiration date is another very critical factor. The shorter the expiration, the more frequently you can collect option premiums, which is very enticing. But also, it means that you have more decisions to make. Longer expirations give you more time to see how the stock performs, but it might also limit how often you can wheel through the trades. Balance your strategy based on how actively you want to manage your positions. Delta is also extremely essential. I make a lot of my decisions just off of delta alone. So look, this is how you want to think about delta. It is the likelihood that the stock will fall below your strike price. A lower delta means there's less chance of assignment, but also lower premium. So higher delta options offer better premiums, but they're also going to be higher on the risk because you have a higher chance of getting assigned, which is a little bit tricky because you don't mind getting assigned in the wheel strategy. So this is a non-losing strategy. I love teaching non-losing strategies to students. Now, choose a delta that aligns with your level of risk tolerance and income goals. Remember, the wheel strategy isn't just about selling puts. It's about cycling through positions, selling puts to get in, to get assigned. So you actually wouldn't really mind getting a higher delta. Now, I'll be honest, I go for around a 30 delta. I get assigned about 3 out of 10 times, and 7 out of 10 times, I just collect premium and I just cycle through and I do it again and again and again. And that's how I love to start off the wheel strategy. However, you can also go for a 40 delta. If you want a little bit higher income, you go a little bit higher delta. And there's nothing wrong with that. Selling a put begins the cycle process. That's how you generate consistent income. If you manage it well, of course. If you pick the wrong stocks, nobody can save you. But look, always keep track of your stocks and be prepared to adjust your strategy if the market conditions change. You do have to adapt. You can't just stand still. The market is always adapt. So for instance, if a stock you sold a put on starts to perform poorly, you might want to reconsider your approach or exit the strategy. Most of the times, it's very rare that I actually go ahead and reconsider the strategy, because this is a proven strategy that I've been using for literally like 7 years profitably and 3 years unprofitably, because my first 3 years in the stock market, I did not really know what I was doing. And then I had experience. I finished my degree, had work experience at Goldman Sachs, 2 hedge funds. I started to really understand, put the pieces of the pie together. But guys, this stuff takes time. So one key tip to really understand and regularly review your stocks is just to see what kind of delta you have, what exposure do you have, how much does each option represent as a total of your portfolio, because I do recommend 10 to 15 stocks in your portfolio. So if you have a position that's too big, that's going to be too much risk in your portfolio. So you really want to understand this on a deeper level. And you also want to use put options to ensure that you meet your criteria. The best thing is you have so much control when you sell a put option. You're literally in control. That's what I love. Because when you buy a stock, you really don't know if it's going to go up or down. The stock market is pretty random, right? You can watch all the videos in the world about the news, what might happen. You never truly know. But with options, you do know. You know exactly the risk that you're taking. You know exactly the strike price. You know the time frame. And then from there, you just need to manage your position. And there's so many tools that you can use. One is you can just let it go to expiration, because with the wheel strategy, you don't mind getting assigned, all right? If it goes into the money and for some reason your perspective on the stock has changed, you think it's worse stock than it was whenever you opened the position, you can actually adjust the strike price. You can go from, say, a 95 down to a 90. You can go from 90 to 85. That process is called rolling, and I will cover rolling as well. So the ongoing assessment helps you, basically stay aligned with your investment goals, and you get to adapt to the changes in the market, which is the best thing when you're selling puts, because the market's going up and down. You can't predict it. But when you sell a put, it's lower than the current stock price. So if the stock price is 100, why wouldn't you want to sell a put option for 95? You get to buy the stock at 95 and you get paid for it. Someone's literally handing you money. That kind of seems crazy. Why would someone do that? Well, the truth of the matter is a lot of people are afraid of the market. They're looking to hedge their position. They're looking to have less exposure. So that's why they're buying put options. And research shows, guys, I worked at Goldman Sachs. I read countless articles, okay? I wasn't the best employee. I'm not an employee type. So all I did, for the most part, I did my bare minimum work, right? And then I did a lot of research on options. So I was looking at how do covered calls work? How do I sell puts properly? I was looking at the data for what delta to pick. And I've personally had so many years of experience now that 30 delta, you can always adjust your strike price if needed, but you don't usually need to. Like literally 90% of the time, you don't need to change anything, because when you sell a put option, again, it's lower than the current stock price. And because the market does follow a random walk, okay, I'm one of these investors that is fairly neutral on the market at all times. I think we're going to be bullish for the long term. In the short term, I'm not an investor that tries to predict the short term. I know that's very popular on YouTube, but I'm looking for consistent, safe, passive income. I'm looking to generate 15, 20, and $1,000 or more dollars per month. It does depend on the portfolio, because some students I work with do have smaller portfolios. They might be at 30K or 50K, but the students that have 100K and plus and 6-figure accounts, they're able to generate 5 figures and multiple 5 figures per month, which is a very nice lifestyle. You can then travel and go all over the world. And that's why I'm traveling. I have an office in multiple places in the world. So the beauty of the wheel strategy is it's very adaptable, and you have to adapt to the market, because we all know the market is the market, right? It's crazy. It moves up, it moves down. When I was working at Goldman Sachs, one of the investors, there was an investor, there's financial advisors, and one of the financial advisors, said that the market's job is to make the most amount of people feel stupid or look stupid. So whether you're a seasoned trader or a newbie completely to options, you can always tailor your investment style, your risk tolerance. You should always be adapting and learning. And that's how you generate consistent weekly and monthly income. It's very possible. I've done it with 4,000 students now. So for beginners, start with stocks that you know well and gradually expand to gain more experience and knowledge. And remember, education and practice are your best tools for mastering this strategy. You want to sell puts often. Once you get assigned, do covered calls. So if you're new to option trading, consider starting with a demo account or even some practice trades. I think there's nothing wrong with that. But also do pay attention that in my Discord community and in my videos, I'm often covering stocks that are not that expensive. Palantir, American Airlines, HIMS, and I have many stocks that are not that expensive. So when you sell a put option, keep in mind it's safer than the stock market. So you don't really need to start with a demo account. You can just start selling puts slowly. And as you get assigned, right, if you're going for a 30 delta, you'll get assigned 3 out of 10 times because that's what delta means. Delta gives you the chances that the option will expire in the money. So if it's a 30 delta, that's 30 out of 100 trades will expire in the money. So when you're selling a put option, you'll be getting assigned. And then once you're assigned, look, it's actually a very simple process. You decide for yourself. If it's way below your average cost, you may decide to wait for the stock to recover. All right. So I recently have done this and I got into a little bit of hot water. Hot water, to me, it's not really hot water. I think it's perfectly fine because if you sell a 40 delta option, as I'm going to show you on my screen right here, I'm going to go into my portfolio. I'm going to show you some examples. They're going to be very interesting for you to understand. And this is the only video that you have to watch on the wheel strategy. So once you see the examples, you'll see that it's okay to get assigned.
Alrighty, let's introduce the wheel strategy and go through some real examples. I'm going to show you a low risk and consistent option play that I'm going to make on Nvidia. I'm also going to show you an example on American Airlines because specifically, even when a stock doesn't move that much, you can still make a lot of money. Now look, my portfolio is up 2% in the past week, up $65,000. Things are going phenomenally. I have been crushing it and I'm very happy with my one-on-one coaching students. So let's just jump into Nvidia right now. Nvidia is one of my top plays. I love Nvidia on multiple levels, both from the technical side as well as the fundamental side. Now look, Nvidia right now is at $116. I have several different option positions. And in fact, I'm running the wheel strategy on multiple different levels. I have a 107 sell put and a 102 sell put. Both of those are expiring in October in a very short amount of time. Now, let me show you how I would basically start off the wheel. So if I go to the 1 month return right here, you will see that the bottom for Nvidia was around 102. So no surprise that I am selling around this level. Now, the reason why I'm doing this is I'm always looking for support. I always want to find the support of a stock. If I can find the support, I'm very comfortable selling put options around that support level because that gives me a very low risk of getting assigned. So delta doesn't always matter. I'm going to contradict myself. If you look at a stock and you see that it's at a 52-week low, delta basically doesn't matter. If it's a high-quality company near its 52-week low, it is a no-brainer to sell put options. You can make a lot of consistent income by selling put options at even a 3-month low. So that's why I'm looking at the 1 month low. If I look at the 3-month low, Nvidia has actually had a double bounce. It has had a 98 low point on August 7th. That was a while ago. And a low point at 102. And that's why I've been selling options on Nvidia around, I've had 98 sell puts and I've had 102 sell puts. But right now I'm specifically very bullish on Nvidia. I think that this level is very cheap. And in fact, I would say around $107 per share would be exactly where I would want to buy Nvidia. So here's what I would do. I would go to sell put option. And now I'm going to pick an expiration date. So look, to do the wheel strategy, this involves selling a put option. And then if you do get assigned, you start selling covered calls. And you don't mind this at all because it's very safe. It's a great alternative to just buying stock. It's way better than that. And one of the highlights of how selling puts helps you acquire stock at a discount is that you get paid income. And if you get assigned, you have to buy shares. But I would love to buy shares of Nvidia. In fact, if the market was open, I'm a little bit pre-market right now. If the market was open, I'd be adding to my Nvidia position. But nonetheless, let's go to November 15 expiration. Okay, I'm going to open this for November 15, and I'm going to sell a put option. I said 107 is base. Here's something really interesting. I said 107 is basically where I think it's a really, really good purchase. But look, even the 110, the break-even price is 104, and that's because the 110 strike, and then you collect $560 worth of premium. Right here you can see the premium is $560, and that's why the break-even price is the 110 minus the premium. So I would be even happy, and I would be way, below my 107 estimate of where I think Nvidia is an absolute steal, like an absolute steal, even at 110 because of the premium. So I can go a little bit higher here. You can see how even at 115, I'm getting that 107 price. So I'm going to go ahead and choose this option right here because 115 is pretty close to 116. Right now, this would be a high delta option at 0.43. So it looks like I'm breaking some rules, but the fact of the matter is the wheel strategy allows me to buy a stock where I want to buy it. And on Nvidia, I want to go higher delta. Now, look, when I'm running the wheel strategy for risk management, if you want to have good risk management and you don't want to get assigned all the time, you want to have 10 to 15 positions in your portfolio, yeah, you want to go for 30 delta, maybe even 20 delta. It depends on your level of risk. That's why I do one-on-one coaching now. I'm going old school. I no longer just sell a cookie cutter program, or not that my program was cookie cutter, but I no longer want to sell to the masses. I want to focus one-on-one. I want to go old school, work with you one-on-one on Zoom calls. And that's because each situation is unique. And for this right here, the 115 sell put that I'm going to open up when the market opens, I'm going to be very happy because Nvidia, I think, is a very good value at $107 per share. I'm going to sell the 115. And here, basically, I'm going higher delta, which in theory is higher risk, but there really isn't any risk because when you're going for the wheel strategy, you want to acquire shares, and the benefit is that there's very low management. That's one of the best things. When I work with retirees who are just looking for safe, consistent, passive income, they're not looking to day trade, they don't want anything risky, they just want to make their 2, 3, 4% per month. Many of the students I work with, obviously my one-on-one coaching is a luxury. And I like to work with folks that have, 50K or 100K. When you have a 100K portfolio and you're making 3% a month, that's $3,000 a month. Not bad. At 200K, that's $6,000 a month. Maybe more. My last month was very good. I had over 6.5% return. So obviously things vary based on the market. But what I love about the wheel strategy is it is low management. The wheel strategy requires minimal management. You sell puts, wait for expiration. This is very important. A lot of my students, they get in their own way. It's not the market that's your enemy. You are your own enemy because many times students will panic and they start wanting to close positions. No, don't do that. You want to wait for expiration. In my research, when I was working at Goldman Sachs, I had many access to a lot of research articles. And I did basically cross-sectional research, which is looking at many different research reports. And I've determined for myself that waiting to expiration is not just the least amount of work, the lowest amount of management, it's also, honestly, the highest amount of results. So for me, once I do get assigned at expiration, if it's in the money, I don't do anything before, that's okay. Because once I get assigned, that next Monday, I am selling covered calls if I get assigned the shares. This is, by the way, the wheel strategy. It's safe. It's safer than stocks. It's a moderately bullish strategy that profits from stocks you already want to own. So I'm going to open this position once the market opens up. I'm going to sell. Me personally, I'm going to open up 10 contracts. So I'm going to do 10 contracts here. I'm going to go for the bid price of 7.8 or so, right? And I'm going to collect $7,800. My max loss here, let me explain this to you real quick because this looks scary, but it's not. This means if the stock were to go down to zero, that you would lose 107K. But Nvidia is not going to zero. Okay, then it's a high quality company, so you don't have to worry about that. Really, you can start losing money below 107, but the support is super strong at 100. Like, how much money can you really lose? I'm basically going to make $7,800 at 100. Even if it went down to 100, I would lose about $700. So this is an even money bet. So I can make $7,800. I can quote unquote lose $7,000 on paper and get assigned if it's at 100, but it would quickly recover. Honestly, it would quickly recover. So this is a 1-to-1 risk to reward ratio, but the recovery on this would be absolutely insane. So I really don't have much worry about a position like this. And I mean, just look at my portfolio. I mean, I've grown my portfolio. Let me go back to my portfolio. I'm going to show you an example on American Airlines. My portfolio has been in growth mode for, week after week, 1 to 2%. Now, not every week is 1 to 2%. Sometimes I have 0.75%. Sometimes I have 0.6%. Sometimes on earnings, I have 3 to 4% returns, right? During earnings weeks, there's a lot of opportunity. And sometimes I have losing weeks as well. Guys, I'm the only guy that's transparently showing you everything, my wins, my losses, and not really fudging my numbers, right? I'm telling you, I have losses, but I win most of the time. And I've been doing this for a long time, so it's pretty easy for me now, but it really wasn't always like this. And I'm going to show you the technicals, by the way. Let's go to the chart right here on American Airlines. American Airlines has done nothing. It has been going sideways. Now, on the surface level, to you, you might think to yourself, well, why is Henry trading American Airlines? I like industrial stocks, guys. Industrials is a necessary component in your portfolio. And industrials like Caterpillar and American Airlines and Delta Airlines is a fantastic addition to have in your portfolio. But look, American Airlines has been going sideways. It hasn't really had a whole lot of movement, has had a big dip right here, and now we've just recovered back to $11 per share. So look, the wheel strategy is a moderately bullish strategy. So when you're selling options, you actually don't want the stock to move that much. I recently acquired a little bit more shares. I did get out of this position because I was running the wheel strategy and I got stopped out of the position. I ended up losing my shares, and that's fine. That's fine. When a covered call goes into the money, if I'm up a little bit of money on there and the covered call is in the money, I just let it sell off. So look, let's go to trade American Airlines options. Let's go to sell. Now, let's go to an expiration date. Let's go November, okay? So if I were to sell a put option at 11, you'll see how basically this is 6% return in 1 month. How insane is that? That's insanely good. 6% in 1 month on a good quality company that's moving sideways. Literally, guys, I don't know how to give you a better money printing machine that's passive, that doesn't require that much work, that you can just literally click a button to make money using your capital. Literally, look at the pattern. You don't have to be a rocket scientist to understand that American Airlines is moving sideways. Premium is really good. If I expand this option right here, the implied volatility is very good. The volume is good. The bid-ask price is very tight. Now look, the bid is 0.66, the ask is 0.69. It means there's very little slippage cost, guys. When you have a wide bid-ask price, that's very bad. That means there's a lot of money that's being lost, and someone else on Wall Street is making money because they're making a market, right? They're buying at 66 and they're selling at 69. That's good for them. But you as a retail investor and myself, I'm always looking for a good bid-ask spread. I'm looking for good volatility. The delta here is high, but look, I don't care because of the pattern, because of the technical analysis. I'm confident. Been doing this for a decade. This works. I've been doing American Airlines for years. I've been talking about Palantir since it was IPO. I've been trading American Airlines for 4 years now, okay? This company is very interesting and it's good to make money. You don't have to use American Airlines, but I'm teaching you the logic and the thought process because I want you to make money. This game of option trading is not only fun, it's exciting, it's very lucrative. So, selling put option here at 11. If it goes below 11, my management strategy will be to do nothing, to get assigned, and then once assignment happens, let's say that it's November, I had to acquire American Airlines. In fact, I think I'm in that position right now. So let's look at my position. I acquired 100 shares of American Airlines. Actually, this was an example that I was doing during my live coaching call. So here I have 100 shares, and guess what? Once the market opens up, my average cost is $10.91. I'm going to sell an $11 covered call option. So this is a very small position. It's $1,000, but this is a perfect example. I'm making $14 on 1,100, okay? Now I'm going to be selling a covered call option. I'm going to show you which covered call option I'm going to sell today. I'm going to go to sell call. I'm going to go to, let's go to December. It doesn't even matter. The whole point is you are collecting income, all right? The 11 covered call is going for $1. This is literally a 10% return in 89 days. How insane is that? Literally a money printing machine. Now, if you wanted to go a little bit out of the money, like the $12 covered call here, I think that's also a very fantastic idea because essentially you get some upside. So let's say that you got assigned at 11. Okay, if you sell $12 covered calls, not only do you collect the premium here of $62, but you also have the upside from the stock itself going from $11 to $12. So you get a whole $1 increase. Now, the reason why I like American Airlines, again, is because the technical analysis is very clear and understandable to me. I like to make money in simple ways. I don't want to get complicated. I just want to have that safe passive income to continue traveling and living a good lifestyle. And really, I enjoy the work that I do. So I am a one-on-one coach, and this is my number one strategy. I focus on this strategy primarily when I have my one-on-one Zoom calls. If you want help, simply click the first link in the description. It's the only link in the description. The only thing I do is one-on-one coaching. Discord is included, but the focus is going to be on old school, working hands-on. That's what I enjoy to do. That's my passion. And the program might be full, but whenever there's spots open, I'd love to work with you hands-on if you have a decent-sized portfolio and you want to grow and make $10,000 to $20,000 a month consistently. Or even starting off a little bit smaller. $5,000 a month is a great goal as well. Anyways, not going to ramble on too much. Hope that you have a fantastic day. Keep investing. Stay safe. I'm super blessed and happy to be here to help you on your journey. Make sure that you subscribe. We are growing our family here to 300,000 subscribers. And thank you so much. Hope you have a blessed day, and I'll catch you in the next one.